Hello and welcome to the most important interview for the economy. I have with me Governor, Reserve Bank of India, Mr. Das. Mr. Das, thank you very much indeed for giving us time. Really grateful for this. Now, every viewer, and today the viewership is like really teeming, would want to know about interest rate cuts. Please don't tell me aligned to the target, inflation aligned to the target. We heard that. After that, we've had, Powell saying that we cannot keep rates too high. We had an ECB cut. And much more important, domestic core inflation has come below 3%. So what would you guide?
You see, I'll be very forthright. I'll be very straightforward. First of all, good afternoon and namaskar to all your viewers. I'll be very forthright. In fact, it has made my endeavor and effort throughout to be as forthright as possible, and not to sort of try and camouflage the real issues by giving some, some generalized kind of reply. Now, when you talk of interest rate cut, now, of course, everybody always, at any point of time, everybody talks about interest rate cut. There is another whole lot of people who are the depositors, the silent depositors, who are, who would be affected in a different direction. Now, that is one aspect. Now, when the inflation is at our inflation, the last print was 4.7%, and the June inflation is expected to be, out tomorrow. That is also expected to be, as per the surveys done by various wire services, that is likely to be close to 5%. So when we are at 5 and our target is 4, I would feel it is too premature to talk about interest rate cuts. Now, some central banks do some kind of advance guidance saying that, it is not far away, or, we are getting close, something like that.
That was my ask.
Yeah, but the issue is the overall economic environment globally, not just in India, globally and in India, it is so uncertain to talk in terms of interest rate cut that I will do it, 1 quarter away or 2 quarters away. You say something and then you have to sort of take back whatever you have said today. So basically it is the uncertainty which is the one aspect. Second thing is the CPI headline inflation continues to be close to 5%. In fact, as I said, according to the surveys done, it's likely to be again expected to be close to 5%. So therefore, from that context, I think it is too early to talk about interest rate cuts. And I would rather not give, any kind of forward guidance, which may, I said it, I think, somewhere else. I would not like to give any kind of forward guidance which would lead the market players and the stakeholders and others to board the wrong train.
Okay. Now, I'll look at it this way. See, there were 2 MPC members who spoke about the neutral rate. Now, just a word to our viewers, the Reserve Bank and all central banks look at the difference between the interest rate, repo rate, minus inflation. That gives the real rate. Now, the real rate at the moment is 200 basis points. If you look at your 1 year ahead inflation forecast, 4.5, we are at 6.5. Now, what is the neutral real rate according to you? We thought we will get it in the bulletin. The MPC members think it should be 100 basis points. What do you think?
You see, with regard to neutral rate, let me use the word neutral because that is much more accurate. The neutral rate, first of all, as you know, RBI a few years ago, our research teams had done a study according to which the neutral rate was about 1.6 to 1.8%. Then immediately in the aftermath of the COVID, somewhere in 2021, our research teams in the Reserve Bank, they came out with a number which was 0.9 to 1%. Let's take it as 0.9 or 1%. Now again, our research teams are working. What is what is possibly a neutral rate? The main issue with neutral rate is that it all depends on which period you are looking at. Now, and neutral rate also is subject to so many structural changes which, which happen in the economy. Now, let us say in between we had the COVID pandemic. So that had a structural impact on the economy and had an impact on the neutral rate. So neutral rate came down to 1%. The other uncertainty is that neutral rate also depends on what is the potential growth
Yes.
you are assuming, because that is a very important determinant of the neutral rate. So it is whether your inflation is at target and whether your growth is at potential growth level. That is basically the place where your rates are neutral. Now, so therefore, it is subject to so many uncertainties. It is subject to so many structural changes. We did one analysis immediately after the COVID. Now the next analysis is being done. I think it should be over in the next couple of months or so. Once that is out, once that is completed, we will release the number. Now coming specifically, if I can, answer your other part of your question. Now coming to, this monetary policy decision, etc.
They are saying 1%.
Yeah. You see, at the end of the day, neutral rate is subject to so many uncertainties. It is also a theoretical construct.
Yes.
Policy making in the real life, policy making in the real world has to be driven not by a theoretical construct, an abstract theoretical construct, if I can put it that way, but has to be guided by the actual numbers. And what are the actual numbers? The actual numbers here are inflation at 4, whether we are at 4%, and growth where we are. Today, inflation is at 5%, headline inflation is at 5. We have projected a growth of 7.2. We are still quite a distance away from our target with regard to inflation. Growth is holding, is holding quite well, and growth is 7.2%. So therefore, you have to make, policy making is being made in the real world, and you have to go by observable numbers, not by a theoretical construct.
But would you say the economy is growing faster than potential, or is it growing at potential at this point in time?
You see, economy, when you talk about potential growth, I mean, this question also comes up, that is, what is India's potential growth? I think with regard to growth, what is important is not to look at the number per se, but to look at the direction of growth. I have said elsewhere, and it is just, I have quoted the facts, it's not as if I am saying anything new. The last 3 years, GDP growth is an average of about 8.3%. For current year 24-25, we have given a projection of 7.2%. And there are many drivers of our growth which are playing out their role. The momentum of economic activity, the momentum of growth in the Q4 of last financial year, that is January to March, was very strong. And the momentum of economic activity in the in the quarter ending June, that is the first quarter of this year, also continues to be strong. So given this, I think 7.2% which we have given at this point of time, it looks very much achievable. And again, if you look at the growth from demand side or supply side, now supply side would be basically how your industry is doing, how your agriculture is doing, how services are doing. In demand side, if you look at, let us say, how consumption is doing, the private consumption, public consumption, or rural and urban consumption, you look at investment, you look at
that
your
is running weak, no sir?
Sorry?
Consumption is running a little
Consumption,
weak.
let me tell you, okay, since you are asking me, let me put it this way. So far as the supply side is concerned, agriculture is expected to do well in the current year, good monsoon, and the season is looking good. Agriculture is expected to do well for the current year. So far as industries is concerned, the manufacturing sector is doing very well. The IIP numbers are very much in the expansion zone for a very, for considerable period of time, for past so many months. The latest IIP numbers are also, not IIP, I'm sorry, the PMI numbers.
PMI numbers.
I'm sorry, I mean the PMI numbers. The manufacturing PMI as well as the services PMI have, again, they're remaining, they are higher than what it was in the previous month. And services is doing very well from the supply side. In fact, our service exports have also gone up strongly. Overall, service sector activity at the moment is very strong. Now, coming to the demand side, you asked about consumption. Urban consumption has been quite strong for quite some time, and it is remaining stable. Rural consumption, which was lagging behind, has picked up. In fact, it was out there in the media that the FMCG sales, rural FMCG sales have picked up. And given the fact that we have an expectation of a good monsoon, and incidentally the NREGA demand has also fallen, and considering that we are expecting a good monsoon, and the monsoon is now very much active in many parts of the country, the rural purchasing power, thanks to a good agriculture, will also go up. So urban demand is holding stable, rural demand is picking up and is likely to improve. The third component on the demand side, as you would know, is the net exports. Our exports have picked up.
Yes.
Services exports are very strong. So if you put all these things together, I think what we are looking at is that India is on a trajectory of higher growth. And I said it elsewhere that I think there is a structural momentum to our growth drivers, and we are moving towards 8% growth. What I have said is that we are moving towards that.
Yeah.
So therefore, I am quite sanguine about India's growth. Coming specifically to the potential growth rate, on potential growth rate, I would like to say it is the direction of growth, which is important, not the exact number, whether it is 7.2 or 7.5 or 7.7.
No, the 3-year average looks good also because the previous was a contraction. So you got 9.7 and therefore the average is high. I took a 10-year average, it comes to 6%. I took a 20-year average, annual is 6.5%. Do you feel in the next 3 years or so, we will be substantially higher than that?
You see, when you look at time horizons, you said 10-year period and 20-year period. In the last 10 years, there were structural breaks.
Yes.
Like COVID pandemic was a major structural break. If you take into account the last 20 years, you had some structural drivers by way of, let us say, reforms like GST, IBC, monetary policy framework, introduction of the MPC framework and all that. So that was a kind of a structurally, they were positive, but structurally negative, where the COVID and the commencement of the war in Ukraine, then sudden squeeze in external sector demand and all that. But now we are getting out of it. So therefore, I think, again, a 10-year average and a 20-year average, you have to discount out these kind of structural idiosyncrasies or impacts, and then look at the growth momentum. So far as our current scenario is concerned, let us say post-COVID also, I think the growth numbers are gradually, the base, statistically the base factors, the base factors are also gradually evening out. They're gradually evening out. That's why you see current year 7.2%, not 8 point something.
But better than 6.5, you would say? I mean, since
certainly.
You expect in the next 3 years. Okay.
In fact, I would expect the, international agencies and others, I think some of the rating agencies have also revised their growth projections upwards. And some of the internal...
So more upgrades are likely.
More upgrades are likely. Even the international agencies also, which are expected to give their projections in the next maybe few weeks or months. Let us watch what they are saying. But I see clearly the upward trajectory, growth is on the upward trajectory.
Okay, then let me come back to the interest rate question. Is what one factor holding you back is the asset inflation, the perceived froth in the stock markets? Is that holding you back on rate policy also?
No, not so much. I mean, I would not say not so much, but let me say we watch all aspects of the economy, including the stock markets, more from the point of view of financial stability.
Yes.
What kind of spillovers it will cause to the overall economy. So we look at the stock market scenario, whatever is happening in the stock market or whatever is not happening. I mean, basically the stock market scenario, by us, we analyze it from the point of view of, more from the point of view of financial stability. Coming to inflation, coming to rate hike or rate cut, coming to monetary policy, we are governed by our inflation growth.
By goods inflation. No, I take your point. What I'm only saying is, does it worry you that you should not cheapen credit when the markets seem frothy?
No, I mean, so far as that's what I said. That is, we look at the kind of spillovers the stock market, or for that matter, any development in any part of the economy, what kind of spillover it will have to the entire financial system and to the entire economy, whether it is stock markets or the bond markets, or so many components are there, so many segments of the economy. We look at what spillovers they will cause. Now, so far as the banking sector is concerned, we are very closely, we monitor all banking, meaning the credit sector, or the credit growth, all that is, this segment is concerned. We very closely watch this position. In fact, much closely than it was, a few years ago, much more closely than a few years ago. And whenever we see possibility of whenever we see some early signs, or whenever we feel that a few months down the road there could be a problem in this particular sector or subsector, we act. And an example is the unsecured credit, where we took action last year in November. And we increased the risk weights, and the results are there to see.
Okay, that's exactly what I'm saying. See, the F&O volumes was something that troubled government, RBI and SEBI. And SEBI has appointed the Padmanabhan committee on it. So do you have this fear that bank money could be fueling the stock market rally? And therefore, is there a case for higher risk weights, or even to keep the interest rate, on watch?
You see, so far as bank money going to sort of create some, giving some boost to the stock markets, etc., is concerned, the exposure limits of the banks to the stock market, individual borrowings from, let us say, NBFCs, which were very high earlier for participating in IPOs or for going to the stock market, the IPOs or for FPOs, whatever, even there we have put a limit of 1 crore. It was all done some 2 years ago. It's not something we did yesterday. So therefore, at the moment, so far as from the point of view of the credit sector, there are no major concerns.
Okay, you don't think fresh controls are needed? And
in any case, banks have their own, end-use monitoring. Only some amount of, you can say, some amount of unsecured credit may go into the stock market.
Exactly.
May go. But so far as unsecured credit is concerned, we have already come out with, we have provided for additional risk weights, and the overall growth of unsecured credit has started moderating.
So you don't think more is needed?
That I cannot say. As and when something is, because it all depends on the numbers and the future outlook. So we keep on constantly evaluating. As and when some measures are required, I can assure you that the Reserve Bank will be proactive.
Okay. You're not done with risk weights?
Depends on how the situation plays out.
Okay. All right, let me come to the other big story where Reserve Bank grabbed the headlines, the dividend. You gave a very high dividend of 2.1 trillion rupees to the government. You would have some desire as to what you want from the budget. Would you want it to be used for fiscal deficit reduction? What would your best ask be? I mean, it's only a wish.
Well, I will not give you the answer which you want, but I will give my answer. Now, so far as the dividend payment is concerned, we cannot link it to it cannot be linked to our expectation from the budget. It is provided in the RBI Act that the surplus has to be transferred to the government.
Yes.
And the surplus has to be transferred after making all the provisions required. And the surplus has to be transferred now as per the recommendations of the Bimal Jalan committee. We have an economic capital framework. It is principle based, it is formula based. There is a framework for it. At the end of the year, we just calculate, following the guidelines and the principles laid down, the ECF framework, this economic capital framework laid down by the Bimal Jalan committee. We follow that and do the calculation. And whatever is the surplus that comes out, that automatically flows to the... let me complete. So that automatically flows to the government. And so we have, it's not a matter of my discretion or the discretion of the Central Board of the Reserve Bank. It is principle driven, it is formula driven. So therefore, so far expectations from the government is concerned, let the budget be presented.
No, I'll tell you, it is not, I know you're making it sound formulaic, but as a central banker, if inflation were high, you would not print so much money and give it to the government. Because inflation is behaving itself, it has been falling from the highs, you could give, you apply the formula. If inflation was high, you would not have applied the formula. What I'm saying is, when you give 2.1 trillion, you make life difficult for governors coming after you.
No, I disagree.
It becomes a precedent.
I disagree with you when you say if inflation were, lower.
Yeah, if it were higher, you cannot give such a big deal.
You are saying that we would not apply the formula. The question doesn't arise. You look at this. The Bimal Jalan Committee recommendations came in 2019, in the middle of 2019 calendar year.
Yes.
We applied it for calculation of the surplus transfer for 18-19. For 18-19, the money which was paid in next financial year was 1,76,000 crores. That was the all-time high at that point of time. Then subsequently, if you look back at the last 5 years, after that there was one occasion, I don't remember, when it was 30,000 crores.
Yes.
It was 30,000, 30.
Yes, I remember that.
So how did that happen? 176 did not create expectations. So after that we gave 30,000 crores.
Yes.
And if I again remember correctly, it went up to something like about 99,000 or 1 lakh crore.
1 lakh crore.
But then again it came down to about 57, 56, around that. So therefore, there have been, ups and downs in the dividend payment. So it is entirely formula driven. Whatever is the number that comes out, and no governor will be under pressure. And in any case, there is no such expectation from the government also. The government is fully on board so far as the economic capital framework is
concerned. I'm still trying to make you say something about the budget.
And in any case, as regards printing of notes, the printing of notes depends on the requirement of the larger economy. We don't print notes only to sort of,
What I'm saying is, if the inflation were high,
no, it has well
problem.
settled.
Yeah.
It has the economic capital framework.
I agree that the precedent may not be.
It has well settled, and the fact that over the last 5 years we have given 176, then 30, again gone up, again come down, it proves my point.
Point taken, sir. But I'm still trying to get something in terms of your wish list from the budget, for the simple reason that deposits are growing by 12%, credit is growing by nearly 16%. There is, a hunt for deposits, and bankers and those who deposit money in banks genuinely feel that equity gets a better tax treatment. There is this capital gains debate that perennially goes on. Do you think that deposits need a better tax treatment?
No, I would not like to speculate on any aspect of the budget. I also would not like to sort of give out what are my expectations from the budget. As I have shared with you earlier and with the media earlier also, whatever suggestions, if at all, whenever we have any suggestions with regard to budget or any other issue, we convey it to the government.
But you don't think depositors,
on the budget, I would not like to,
say
anything.
Okay, even outside the budget, bank deposits are struggling because money is getting drawn into the stock markets. So there is a crib that we are losing because we have a tax penalty.
See, there is an interesting thing of, that you're losing to stock market. If whatever goes to the stock market ultimately comes back it comes back to somebody's deposit.
Yes.
If I am selling the shares and you are buying
it remains in the banking system.
It remains in the banking system.
But the time,
so therefore, deposits are not growing. The credit growth is higher. And this is an issue we have been discussing with the banks. Even in my last interaction with the public sector banks and the private sector banks, in fact with the entire banking sector, this issue was discussed in depth between the RBI and the the CEOs of the banks.
Okay.
So the banks will deal with this issue.
Okay. Well, now let me come to yet another issue. Since we're talking about deposits, we have to talk about debt. There is this Indian inclusion into the index, the JPM bond index. There will be a steady flow of money, and even otherwise equity flows are very good. But because of the debt flows, do you think it can be managed in the normal scheme of things, or do you think something extraordinary like an OMO sale or MSS or something will be needed?
No, you see, we have multiple instruments at our disposal to deal with situations of excessive inflows. I mean, there are options of OMOs, there is option of the standing deposit facility, we do the VRRR, variable rate reverse repo operations. So we have multiple instruments at our command, and we will use them as time requires. But specifically about the inclusion in the bond indices, You see, it will happen over a period of time. It is
Yes,
going to
it
happen
is
over a period of
till
about
March.
10 months or so. Over a period of 10 months, it will happen. And I would believe that some of the money which was to come during this period has already come in. Even, once the announcement came,
Yeah.
money has started coming in. So therefore, part of it has already happened. Whatever remains will come in a very, will come in periodic, monthly basis,
Yes,
it will
yes.
come. So what
1% every month.
So therefore, that is not something which, worries us. That is something which we have managed in the past and we'll be able to manage it. I don't see any major disruption on that account.
Okay, I'll tell you one of the things about the way Reserve Bank manages the currency. There are obviously unexpected inflows and outflows. Is this terrific stability? In fact, for some months together, it was only moving between 83 and 83.30 for several months, and then of course you allowed it to fall a bit. Doesn't this lead to complacency among importers and exporters? Isn't that a danger that worries you? They don't hedge enough.
Achha, you're talking about hedging.
Yeah.
Now, hedging, so far as ECB...
RBI is hedging on their behalf.
Somebody may think like that. I mean, somebody may think like that. But I don't think it will be like that, because first thing is that so far as the ECBs are concerned, they are fully hedged.
Yeah.
So that component you have to keep out. Then there is whole, automatic or natural hedging.
Yeah.
People who who have export income, so they have their inbuilt natural hedging. So far as the overall hedging numbers are concerned, for some time in 23, it looked as if the hedging, the unhedged portions were going up. It did look that way. But from January onwards, from January to March, if you look at the numbers, the unhedged part of forex exposures, the unhedged part has started coming down. Okay. And the hedging has gone up. So the businesses and the corporate houses are doing their own assessments, and they are taking a call and they are doing it, and it is something which we constantly monitor also. Last quarter onwards, not last quarter, I mean 1st January onwards, for the it has started picking up.
Okay, so you don't worry that RBI keeping it on a tight leash is...
No, we are not keeping it on a tight leash. Believe it. Market perhaps, or some people may think that, we are only keeping it a kind of a range. It is not so.
No, actually, one of the rating agencies even mentioned it, that it is practically a managed...
yeah, I mean, there are... yes, I am aware about it. But look, India has changed. The macroeconomic fundamentals of India are today much stronger than it was a few years ago. Macroeconomic fundamentals are very strong. The growth momentum is very strong. International investor confidence is also very strong. JP Morgan bond index inclusion also means that, the flows will be there. Our huge forex reserves also gives confidence to the international investors to invest in India, that India is in a position to meet its external payment obligations. So you have to look at the so-called, stability of the Indian rupee in this background.
Context.
So I would say it is more to do with our overall stable, strong fundamentals than anything else. Reserve Bank, I again would like to stress, we only manage excessive volatility.
Okay. But do you think, given exactly the reasons you say, that there is a very good chance of a rating upgrade?
It should have happened even earlier. I would feel it should have happened earlier. But yes, I think it
Our
should follow.
deficit is higher compared to other countries.
Which deficit?
Our fiscal deficit is higher compared to other countries in the BBB minus.
But it is on a, the government has announced a consolidation, fiscal consolidation path.
Yeah.
And the interim budget gave a fiscal deficit of 5.1. And next year, 25-26, it's supposed to be 4.5, according to the roadmap which government has given. Things appear to be moving in that direction. So I think a rating upgrade, it should happen. Yes.
Okay.
It should have happened earlier, but it should happen. Okay. But I think now internationally also, yes, there are some investors who go by the rating, and the cost of borrowing also depends on rating. I am not saying that the rating doesn't play a role. But I think more than that, the large investors internationally today do their own, do their own analysis and take their own call whether, how much they want to invest.
Yeah,
and
markets are ahead of rating
markets
agencies.
are ahead,
I mean,
I think you have put it very appropriately. Markets are ahead of rating agencies.
yeah, the companies, corporates tell us when they borrow. Let me come to the unasked part of the monetary policy, the stance. The stance has remained unchanged for a goodish bit. What do you think, and what will make you change it?
You see, the stance has been, we have called it withdrawal of accommodation,
Yes.
and there is a reason for that. Target is 4%. We are nowhere near 4%. We are still around 5%. But the expectation is that it is moderating, and it is indeed moderating.
Yes.
But the pace of moderation is very, very slow. It was 5.1, then I think it became 4.9, then 4.7. So it is moving very slowly. Now, one idiosyncratic development of some monsoon, flooding or some weather-related event can upset things. The vegetable prices can go up. So therefore, and the point is, even today we are still around 5%. So if we want a faster alignment of our inflation with 4% target, the monetary policy should be much tighter.
Okay.
It should be much tighter, it should be much more restrictive. But we have not done it because we do a balancing between growth and inflation. So therefore we have not done it. We have chosen a calibrated path to aligning the inflation with the target. So therefore we are still quite a distance away from 4% target. Given the distance that we have, which is currently 70 basis points, which may go to 80 basis points, given this much of gap, I think it is, it will be too early to talk in terms of change of stance. Okay. Unless you are somewhere close to 4%. You see, unless you are somewhere there, the question of changing of stance, I think, will be very premature. Okay. It is quite possible. Like, the second quarter inflation number is expected to be lower. But then again, it is expected to go up. Annual average, we have said 4.5%. So when we move towards 4%, on a kind of a sustained, durable basis, only at that point, we may get a confidence to have a relook. Okay. I'm saying to have a relook. Okay. Not okay. More than that.
Okay. No, in preparation for this interview and long-awaited interview for me, I read one of those bulletin chapters which speak about the dynamic stochastic model of growth, and they are forecasting 4% inflation in FY26. That model is forecasting. So I was just wondering if you will give me any hint about...
No, I think we have also, MPR has also given a number for 25-26. The Monetary Policy Report has also given a report for next year. So we are still months away from next year. So let's see.
Okay.
Let's see.
All right, fair point, sir. Let me come to some obvious banking issues.
And also let me say with all sincerity, I'm not trying to sort of dodge the reply. Just imagine the kind of uncertainty that we have. So therefore, and we are nowhere near 4%, but yes, we are very optimistic and quite confident that it is moving towards 4%. It's moving very slowly. So let's see.
Fair point, sir. Fair point. Actually, yeah, tomatoes at 120 rupees, so we have to be careful. It's monsoon. Let me come now to the banking sector questions. The two obvious things that the market is waiting for from you is this project finance provisioning. You have raised it to, you want it raised to 5%, and once the project is completed, even then it is coming only to 2.5%. Standard loans is only 0.4%. So you're really asking for a very big provisioning. Is there any chance it will be softened?
You see, what we have given out is a draft circular.
Yes, it's a draft.
In fact, we are now adopting in our regulations, we are adopting a very, very consultative process.
Yes.
And in fact, in the annual report also, if you recollect, or you may have a look, or your viewers may have a look. In the annual report for, last financial year, there's a separate box item, there's a separate annex, where we have listed out all the regulatory measures which we have taken, the number of regulatory measures which followed a consultation with the stakeholders. Okay. So we are now actively consulting. There is a consultative approach for regulation making. So this is also a part of our consultative approach. What we have put out is a draft circular. We have started receiving comments, and based on the comments that are received, we will examine the comments. and then we will come out with a final circular. The purpose of the draft circular is to adopt a consultative approach to get out external inputs and examine them with all seriousness.
See, this is not a discussion paper. This is a draft regulation. It's
circular.
almost ready to
It's
go.
a draft circular.
So the fear of the industry is that you won't tweak it much. If
It
that.
is a draft. We have said
It is a draft.
So when I say it is a draft, I am not saying that we will not tweak much, or I am not saying we will tweak it. We will tweak it so much. It's a draft circular, and our approach is consultative. We take this consultative process very seriously.
Okay. What about expected credit loss? The ECL rules. Obviously, there will be pushback from some banks. But
No, that is already, I think we are working on it. It's on the final
so
stages.
it is
It's in the
something that
final-
will come in this financial year, you think?
Financial year?
Yeah.
Yeah, of course.
It is coming in the
Yeah,
financial year. FY25, you want expected credit loss?
I mean, it has already, the comments have all
Yes.
come. They're in the final stages of
No, actually, the
examination.
project finance rules, higher provisioning is almost like expected credit loss for
See,
that
why
section.
we
That's
are-
why I asked whether you will shelve that to a later part.
No, we are also equally concerned about how it will impact the balance sheet of the banks. And also, in some situations, the banks need to, this is a part of our macroprudential approach. The balance sheet of the bank has to remain strong at all times. There cannot be surprises. So all risks, perceived risks, have to be appropriately and adequately provided for.
No,
So therefore, this ECL framework, this expected credit loss or the project finance norms that we have come out, this is only to strengthen the balance sheet of the banks, and we are following a consultative process. We
Fair
understand, we try to understand what is the point of view on the other side, what are the difficulties they have, and then we'll move
No, the
forward.
point of view clearly is that they will pass on the cost to the infrastructure company. So infrastructure financing becomes expensive.
Any financing by a bank has to be sustainable.
Okay.
You see,
There is
financing-
competition in the market.
There is competition, and also, you cannot do a financing. The model of financing should not be, should not be subject to any kind of unmanageable, unmitigable risks. Every risk has to be properly assessed, and it has to be provided for. It has to be mitigation measures have to be taken. So therefore, the cost of infrastructure financing also will depend on the perceived risk or the risk assessment. Every bank loan, there is a risk, why do we provide a risk weight? It is based on an assessed risk.
Okay.
So therefore, infrastructure financing also, effort is to see that the risks are appropriately provided for.
Bank investments in technology is becoming huge, especially after UPI. Every other minute, the balancing is a problem. It's a big technological investments. Do you think banks are able to manage? Will they need some help in terms of charging a bit for UPI or something? Are you okay with the bank's technological preparedness?
I think we are now living in an era where banking and technology, they are converging.
Yeah.
Going forward, you will see that there will be more and more of technology in banking. And not just in banking, I think in every sphere of life, technology is playing a bigger and bigger role. So far as the banks are concerned, we have been engaged with the banks for last few years, and constant engagement. As you may be aware, for the sake of your viewers, let me say that in our Department of Supervision of the RBI, we have a C-site team, and the C-site is a full extension of C-site. I am leaving that out. There's a C-site team which does only this IT scrutiny of banks, NBFCs, IT scrutiny of the financial
IT audit.
system, the IT audit, if you call it that way. So we are engaged not only through the C-site team, but also at senior levels with the banks on two or three aspects of this IT facility. One is cyber security. Cyber security is a growing challenge internationally, not just in India.
Yes.
So one is greater focus on cyber security. Second is to ensure that timely investments are made in IT infrastructure. And third is to see that the IT infrastructure is keeping pace with the requirements of the growing volume of business of of the individual banks, or for that matter the NBFCs. The banks, I am happy to say that the investments by the banks in technology, in IT, the kind of sensitivity and the kind of seriousness which the banks have with regard to IT and technology infrastructure has improved quite a lot.
But they have a crib, sir. They have a crib that this UPI, in the process of making it so easy for me to GPay you or something, has made life very expensive for them. There is nothing, no plan at all to ensure that MasterCard, the card payment all over the world.
You are talking about the MDR charges.
MDR.
UPI
There is
MDR.
nothing on MDR. No MDR on UPI.
I mean, there is zero MDR, and I think
You don't
there is
think that
currently
merits a
no.
relook?
There is currently a scheme. Government has a scheme. They are funding the MDR.
to
What
the
the bank should have earned. So there is a kind of subsidization by the government towards these MDR charges. So I think it evens out eventually.
You don't see, this is the start of a new term for the government, so tough decisions can be taken, but you will not.
No, I can't speak on behalf of the government.
No. What I'm saying is,
Because
would you
the exemption.
you be sympathetic to the bank's ask that they should be allowed to some cost of the UPI which they bear, a little more should be reimbursed to them?
So this issue has been discussed with the banks. This issue has been discussed in multiple forums, and that is why the government has given this, this.
They are reimbursing
subsidy.
a little bit.
So moving forward, let's see.
Okay. Well, actually, your term has also been seen as a bit strict. I mean, most CEOs have gotten 2 years when the board recommends 3 years. Are you more of a demanding taskmaster?
I don't know. I thought first thing is, I think I am.
Or RBI has become a tougher taskmaster?
No, I mean, tougher taskmaster meaning there are regulations, there are supervisions, there is a supervisory system. RBI as an institution has a responsibility. Our responsibility is to ensure financial stability, and therefore in that direction we take every measure that is required. And talking about taskmaster and all, let me say that we are really accessible today. I don't want to say it in a comparative sense. The amount of accessibility which the banks, the NBFCs or other sectors of the financial market today have to RBI, it's very high.
Look at Bandhan, RBL Bank. I mean, I can pick up so many instances.
No.
You almost asked for a change.
There are cases where we gave extension for 1 year, but subsequently we have extended it. So therefore, it is all case specific. And overall approach, you are saying that yes, it is our responsibility to ensure stability of the banking system, stability of the financial system, and whatever is required towards that, we do it. And whatever we do is on a consultative basis, and whenever it is perceived that RBI has taken, or whenever RBI takes
even with the NBFCs, of course you defend.
No, whenever RBI takes some measures, any supervisory restrictions or any levying some penalty or etc., it follows a months of interaction, and we really engage with them and give sufficient time for rectification. And there is continuous engagement with the banking sector. But yes, I mean, with regard to perception of people, I can't say anything. I am not offensive about it. I am not defensive about it. But we have a job, and we are committed to deliver on that job and to ensure stability of the system.
Actually, well, in the press conference, we asked you about all the, penalties on NBFCs. So I don't want to repeat that question. But let me come to the MPC itself. 3 members, external members, their last meeting is in August. And then I think your term is December, Patra's term is till January. The whole MPC changes. Not just for that reason, but that is a very good reason to continue you. So that there is continuity in the MPC and, a job well done. Why should the government disturb? Have they intimated to you anything at all?
See, it is like
we would like you in Mint Street. That's why I'm asking.
It's like this. When there is an assigned, you see, first thing is institutions are bigger than individuals. Whether it is the Reserve Bank as an institution, or it is the monetary policy as an institution, the institution is bigger than the individuals. The institutions develop their own momentum, their own discipline, their own principles, guidelines. So institutions will always continue to function. Now coming specifically to this thing, you see, when I am on a particular job, I focus on that job. I am not distracted by other things. Or to use the analogy of cricket, when I am out there batting, I rather focus on my batting and not think whether I am there in the next match or not.
Okay.
So it's that way.
But they have not intimated anything at all about, the post-December person in RBI or your position. No intimation at all from the government.
No, I think, it's again, the question is, I think I said it elsewhere also. As I told you, I'm just focused on my batting currently.
Okay.
Indication, no indication, it doesn't matter to me at all. I am currently in a job. My focus is completely on that job. I try to follow the principles of Arjuna, remain continuously focused on the job at hand, and not get distracted by anything else. And I'm not saying it to sort of make it a kind of a cliched answer or anything. This is what I really mean.
Fair point. I don't want to think that this is an exit interview. I want many more interviews with you as governor. But it's a 5.5 years of.
No, but exit is still some 5
Yes,
6 months
6
away.
months away at least,
So
even for the term. That's why I said I'm expecting another interview. But basically, you've finished 5.5 years. At the end of 6, you will be the second longest serving governor. All other governors have come almost 6 years, but 1 or 2 months less. Only Benegal Ramarao did 8 years. So you would be the second longest serving governor as of December. When you look back, what gave you sleepless night in this 5.5 years? What was the toughest day?
You said you will do one more exit interview,
I will.
no? So there are still 5 months to go. So let's wait for that.
Okay, what is the most happiest day? Like when Rohit Sharma lifted the trophy, since you are using cricket analogies.
See,
what made you really thrilled about, yes, we handled this well?
No, there are so many points when you felt happy. There are so many points where you felt, you feel that, we constantly sort of introspect, I at least constantly introspect and constantly, evaluate that is there something which we could have done something differently and all that. And I think for every policy maker, what is very important is to sort of maintain that equanimity. At least try to maintain that equanimity, not feel excessively happy, not feel excessively depressed. I think all forms of exuberance must be avoided. All forms of depression also must be avoided. We should maintain equanimity.
This is from Arjuna to Buddha, actually. But then, let me remind you that you have told me this is not the exit interview. That's almost a promise that you will speak to us again. Thank you very much, Governor, for sparing time with us.
Thank you, and thank you to your viewers. Thank you.